Today's presentation focuses on depository institutions, otherwise known as financial institutions. A depository institution can be defined as a business that provides financial services and accepts deposits. A commercial bank is a for-profit financial institution that is privately owned and open to anyone. It offers a wide variety of services and is usually very large and has many locations. Credit unions are non-profit financial institutions owned by its members. In order to be a member, individuals must meet certain criteria like living within a certain distance, area code, or have a certain type of job. There are fewer services than banks offered by credit unions, but they do pay higher interest rates on deposits and charge lower fees or interest rates on loans. A savings bank or a savings and loan is a financial institution similar to a commercial bank. The main difference is that a commercial bank tends to concentrate on working with business customers and offering a variety of services, whereas a savings bank focuses on home mortgage loans. You may have seen or heard about the companies Ally or SoFi. These two companies are online-only banks. It may be obvious, but online banks do not have a physical location. They do, however, have higher interest rates than banks do on deposits, and they may not charge monthly or overdraft fees like most banks do. The disadvantages, however, are that it's difficult to deposit cash unless using an affiliate ATM, and there's no in-person customer service if you run into problems. The FDIC, or Federal Deposit Insurance Corporation, offers protection to banks and non-credit unions in the amount of $250,000 per depositor, per institution, and per account. This means that if the bank fails or goes bankrupt, individuals are insured up to $250,000. The same type and amount of insurance is provided to credit unions and its members by the NCUA, or National Credit Union Administration. Whether saving money or borrowing money, your financial institution will likely enable you to earn interest or be charged interest. Interest is the price paid for using someone else's money. The amount of interest earned or charged is determined by the interest rate, and it typically is calculated on an annual basis. Financial institutions offer a variety of savings tools, but are best known for offering accounts that allow individuals to help manage their money. Most commonly, these are checking and savings accounts. Using a checking account provides the user quick access to funds for a variety of different transactions. Once money is deposited, an individual can write checks, use a debit card, withdraw cash, or electronically transfer money. Some earn interest and some do not. Commercial banks may elect to offer interest-paying checking accounts, but they're not required to. Credit unions, on the other hand, must offer accounts that earn interest for its users. As the name implies, a savings account is designed to help you build your wealth. It is not intended for daily expenses. A savings account limits you to 6 withdrawals per month, but it does enable you to earn higher rates of interest. Credit is the method that individuals use to borrow money. These are used for loans like mortgages or to pay for a car, or for credit cards for everyday use or for emergency situations. Over the course of time, you'll pay back the money borrowed plus interest until it's paid off. Many banks have individuals that work on site that provide information, advice, and assistance on a wide range of financial topics. Some individuals use their local financial institutions to keep valuable personal items safe. These can be locked in a bank vault in something called a safe deposit box. And in some unique situations, individuals may want to take advantage of special needs payments like traveler's checks, certified checks, cashier's checks, and money orders. Let's take a look at some common features offered by a variety of depository institutions. Online banking is exactly what it sounds like. It allows an individual to access their account with a username and password on a secure internet site. Some of the functions that can be performed include accessing account information, transferring money, paying bills, and applying for credit. A specific form of online banking is mobile banking. This is when an individual is able to access their account using an app on their smart device. These mobile banking apps usually offer the same services as online banking, plus it allows the individual to remotely deposit checks. A debit card is a plastic card that electronically connects you to your account with a personal identification number or PIN or a signature. It functions like a check but faster and is more portable, and any retailer that accepts credit cards will likely be able to accept your debit card. An ATM is simply a computer banking terminal that allows you to deposit money, withdraw cash, transfer money between accounts, and check account balances. You can access all of these features using your debit card and PIN. As technology has evolved, new forms of payment have been born. Contactless payment allows the individual to make no physical connection between their card and the point-of-sale terminal. They simply wave or tap their card on the retailer sensor. An overdraft fee is a fee that's charged to an individual who takes out more than what is actually in their account. For example, if you have $100 in your account, but make a purchase of $101, you'll likely be charged an overdraft fee. An ATM fee charges an individual for using an out-of-network ATM. This means that if you bank at Wells Fargo but use a Lynn Area Credit Union ATM, expect to pay a couple of dollars to the owner of the machine. Some financial institutions expect for you to keep a minimum balance in your account. A minimum balance fee charges you if you go below that balance.